Hello everyone, welcome to CI LMR YouTube channel. So today we are discussing the important questions for the last minute revision for MBA Financial Risk Management subject. Let us first see what is the question paper pattern you will be going to get in this upcoming exam, like June 2026. Part A, you will be having five questions of 2 marks from it will be going to occur from all 5 units, and there is no option, so you need to write it will be for 10 marks. And next, in part B, if you see, here you will be having 5 questions of 8 marks, total 40 marks, and here sequence is 6 to 10, and you will be getting A and B options. In this A and B, you need to write any of the one options, and you need to write all 5 question and answers here. So, and in the part C, you will be having important case study compulsory for the 10 marks. So this is the your question paper pattern. Let's now start revision of discussing the important questions of previous years occurs in last 2 to 3 years, which will be occurs for several number of times, and very important questions will be going to help you in your exam. And this is the first unit, just introduction of financial risk management. Unit 1, first question, discuss different types of risk and risk management method. It is a very basic question, maybe asked several of number of times. So just we need to tell the different types of risk and risk management methods in a company, and they may be asked various types of risk. Explain different types of risk they may ask. So that is the answer, and it will be appeared last 2 times. So let's start. First, types of risk. There are the majorly 5 types of risk. Okay, we discuss one by one. First one is a first type of risk, that is the business risk. Business risk arises when there is a changes in sales or a market condition affects the earnings and values of a firm. So when the business will be going to get the risk means when there is a certain change in the market conditions and going to affect its earnings and value of firm, increase or decrease. So that is the meaning of business risk. And next, here we have types of business risk. We have 3 types of business risk majorly. So here first type is credit or default risk. Credit or default risk is nothing but the amount which we gave to someone from the business, and that amount is not coming it back to the business, means the party or the person who is not willing to pay it back. Such amount we say credit or default risk. Okay, so let's see. Credit risk arises when one party fails to fulfill the financial obligations. Okay, so he is not willing to pay your financial, whatever the financial obligations. And if other thing, if you want to see, means it is also known as a counterparty risk, because the risk we are generated by some other party from outside the company. So that is also known as a counterparty risk. And one more thing here, the risk it represents the risk of non-payment. They are not able to pay it back, so we say it is a risk of non-payment. And next, if you see here, price risk. Second type of risk is a price risk in a business risk. First type is a credit and default risk. In that it is the second, that is a price risk. Price risk occurs when due to fluctuation in the prices of goods and services in the market. Price risk occurs when there is a increase or a decrease in the prices of goods or services. For that risk we say price risk. When there is a change in demand and supply leads to variation in market prices. So, and also not only changes in prices, but also when increase in demand and supply, that also gives the changes in the prices. Next, third risk in the business risk, we have market risk. Very important risk. Different marketing factors are going to affect, then we occurs the market risk in a business. So what are the market factors? Market risk arises due to change in marketing factors such as interest rate. There may be increase or decrease in your interest rate, or exchange rate, when whatever the things exchanging, there may be increase or decrease in your exchange rate while selling or buying the product. Equity prices ups and downs, and commodity prices. So these are the factors where it is going to affect you in your business. So these things when affect, then it will be said as a market risk in a business. And next we have second type of risk. Major second type of risk is a liquidity risk. Liquidity, as we know, the term liquid is nothing but the things which is easily going to convert it into cash. When we get this liquidity risk, means the asset or the liability which is not going to convert easily into cash. Such risk we say liquidity risk. And liquid funds are very, very important for the business, which are going to affect, which is going to help for the business for its operations to run it smoothly. Let's see what it say. Liquid risk occurs when firm unable to buy or sell a asset quickly, because they are not easily converted into cash. They are not ready to easily convert into cash. Because of that, firm is unable to buy or sell a asset quickly, okay, without affecting its value. Whatever we have value on that, so we are not buying or we are unable to buy and sell the asset. So that we say liquidity risk. Otherwise, and something else means adequate liquid funds are essential for smooth functioning operations. I said that these liquid funds are very, very important for the business for its smooth operations. So if that only we are unable to buy or sell, means it is very difficult for the operations and smooth functioning. And next, if you see, we have third type of risk, that is a foreign exchange risk. Foreign exchange risk, it means foreign exchange risk arises when business operate internationally and currency value fluctuates. So foreign exchange risk when you are involved in with dealing with your other foreign countries. When you are in, so your exchange between one country to another country, you are doing your business internationally, then this risk is going to occur. Okay, so what they are saying, this is the internationally, and when there is a currency value fluctuates, then you will be getting the foreign exchange risk. You are exchanging, you are trading internationally, buying and selling, okay, from one country to another country. There will be changes in the values. So those things we say foreign exchange risk. Okay, so here we see types of foreign exchange risk. First type is transaction exposure. Let's see, it arises due to change in exchange rate. You are doing, there is a buying and selling, there is a trade. So if there is a changes in such exchange rates, it may be increase or a decrease, going to affect your business. Okay, so they are in international transaction, not nationally but internationally dealings you are doing there, and exchange rate goes increase or decrease, it will be going to affect. And next, exchange rate may increase or increase the business expenses. If the exchange rate increases, our business expenses will also get increases. So that is the risk we say transaction risk. Next we have translation exposure. Here it occurs when foreign subsidiaries and financial statements are converted into domestic currencies. Already everything done, dealing done, now we are getting the payment from foreign countries to our country. So here foreign currency is converting into our domestic currency. So there will be the changes in the values where our whatever the amount maybe decreases or maybe increases. Okay, if it get decreases, the value which the foreign country is paying to us. Okay, if it decreases, means that we say transactional exposure. Already we transported the things, now the payment is remaining from some foreign country. Now their currency converted into our domestic currency. Okay, in that terms, when the value decreases, our amount or expenses also get increases. So that expenses we say transactional exposure. Next we have third type of expenses under our foreign exchange risk, that is economic exposure. So here economic exposure is nothing but changes in the economical conditions. Okay, so here it arises when exchange rate fluctuations affect a firm's competitive position and profitability. Here exchange rate is directly going to affect our firm's competitivity, profits and its values. So there will be going to affect because of economic conditions. Next, major fourth type of risk is we have country risk. If you are doing an international level of transactions and internationally connections if you are going to do, then you will be facing this country risk. Country risk is faced when business invests in invest or operates in foreign countries. When the business is going to invest or operates in the foreign countries, so it is also called as a sovereign risk. Here country risk is nothing but you are involved in some foreign business, your shares are there in your in some other foreign countries companies. Okay, if that shares value increase or decrease, here you will be going to affect. Okay, such things we say here, and also it is known as a sovereign risk. Okay, it is called as a country's name, that is a sovereign risk. And next we have in this country risk, we have economic risk. When that in that country changes in the economical conditions, we get economic risk. Okay, economic risk occurs when the country's economic condition affect business returns and repayment capacity. Already we invested such funds in foreign countries. Okay, so it economic condition goes down, then it affects our returns and repayments. Whatever capacity we have, it is going to decrease. Next we have potential risk in our country risk. Potential risk is nothing but the risk due to changes in government policies, laws, tax, tariffs and regulations. So political risk will be arises by these factors. The other country government may change, laws may change, taxes may change, then our profits or returns from that invested countries may decrease. So these risk we said as a political risk. Next, the major fifth type of risk is other types of risk which may be generally occurs in our business generally. So what are the general risk you can see means, first one is a price risk. Price risk arrives due to fluctuation in market prices. Already we know how the price risk is going to arise due to fluctuation in market price, maybe increase, maybe decrease, or due to change in demands and supplies of commodities. Next, if you see here, we have in that price risk commodity price risk we have. So here they say it results from change in price of commodities such as it may be oil, coal, gas and metal. There may be changes, there may be decreases because of the economical condition goes decreases these values, you will be having the commodity price risk. So commodities such as examples are oil, coal, gas and metals. Next, if you see that is a second type of risk is exchange rate risk. It arises due to change in foreign exchange rates. We are doing the if you are involved in international business, then this exchange rate is going to face by your business. Next one, you have interest rate risk. It occurs due to fluctuation in interest rates that affect borrowing cost and revenue. Okay, so here your interest rate, whatever the interest rate you getting, it may be decrease. Okay, it directly going to affect your cost and revenues. There may be decrease. Such risk will be said as a interest rate risk. Next we have poor risk. So poor risk is nothing but the risk which is unavoidable. It is said as a totally losses, not as a profit. So here pure risk is nothing but it results only in losses, not profits. You cannot control these types of risk. Those risk we said as a pure risk. So such risks generally beyond the control of individual. We can't control this risk by any individual or any organization. You need to face it. So such risk we said as a pure risk. Next we have personal risk. Personal risk means the expenses which can be extended by the person. He did expenses beyond the thing, then the individual need to face. Such risk we say as a personal risk. Here personal risk affect individuals and their dependents. Okay, so such risk we say as a personal risk. Next we have earning risk. Earning risk is directly affecting to the dependents. Okay, so if you are an earner and there are many n number of families dependent on you, it is going to affect those persons. So here what it say means exchange risk is nothing but it arises from losses or reduction of your income due to death, disability again or other factors. Overall you are dependent on such a person. If that person suddenly get death or get disability or again or any some other factors going happen there and the person is not available, then you are overall dependent on such person, then you will be going to have this earning risk. Next you have physical asset risk. Okay, so whatever affect directly any asset get damaged or anything happen or accident happen to that asset which is very very expensive and very very benefited to the our company. Okay, so such damages we say physical asset risk, getting damages of any of the asset. Okay, so let's see here, it involves losses or damages to assets such as houses, vehicles, computers and financial investments. Okay, so whatever here our house get damaged or any fire occurs to our house, it is a very much big loss for us where we stay there. Okay, so physical asset risk, or any vehicles get damaged or accident. Okay, computers get any fire and all. Okay, so these affecting to any of the assets which is very very important. Okay, happening for happen such damages to it means what we face physical asset risk we are going to face in a business. Next we have longevity risk. Okay, here it is nothing but individual outliving their financial resources after retirement. You will doing the job, okay, but suddenly you get retired and your income will getting suddenly whatever the salary income amount or retirement amount is going to reduce. Okay, so you are unable to survive in such amount. Such risk we say longevity risk. When suddenly you get retired and the whatever the lump sum amount you get, it's very less, okay, comparing to your salary, and you need to survive in such amount, we say longevity risk. Okay, and next we have, okay, so these are the different types of risk. Okay, what we discussed, once again we revise it. So first question, that is a different types of business risk. Different types of risk. First is a business risk. In that we discuss credit which is not going to commit back, and in this we discuss in credit risk we have, in business risk first is a credit risk, next price risk, and next is a market risk. So price risk is nothing but ups and down in the price changes. Market risk when there is a changes in the marketing factors. Next type we have liquidity risk. Illiquidity risk is nothing but the asset which cannot be quickly sold or purchased, so which is going to affect your business operations. Next we have foreign exchange risk. If you are dealing with foreign countries, okay, so the things when there is a changes in exchange rates and all, or changes in currency value, will be getting the foreign exchange. Here you have transaction risk. At the time of transaction the exchange rate get changes, it is called as a transaction risk. Translation risk, already dealings has been done but payment has been pending, payments has been converted from foreign currency to our domestic currency, there may be changes in the values, such we say transactional risk. Economic exposure, it is nothing but firms affect is directly to its profits and values. Next we have our country risk. In country risk we discuss economic risk, which there is a change in economical factors. Political risk, where there is a change in government policies, taxes. And fifth type of risk we discuss, where we have discussed general types of risk. Okay, so first one is a price risk. Under price risk we have commodity price risk, where there is a changes in the commodities. And next we have exchange rate risk. When we are dealing with some other country, our exchange rate gets increase or a decrease. Next, interest rate risk. We changes in the interest rates going to affect business and increasing business, it going to affect your business revenues and all. Pure risk, which cannot be controlled, you need to bear it, such risk said as a pure risk. Personal risk, where individual goes beyond its expenses and going to affect to the individual. Earning risk, where dependents are there and the person is the person get disabled or any accidental issue to that person, the dependents are going to face, such risk said as earning risk. Physical asset risk, any physical asset going to be damaged or anything incident happen to such assets, Longevity risk, when you are the person retired and getting the less amount of your salary, such risk can be said as a longevity risk. So this is the first question we discussed. So in this first question we covered overall questions related to about risk. They may ask you different types of risk or any different methods of risk or techniques of risk. So all the answers about risk you can write this whole first question answer for the various different types of risk questions. Next we'll go for the second question. Very important second question also from the first unit. Explain risk management and approaches and methods. Here we are going to cover risk management, approaches and methods. Means all different three types of question we are going to cover in second question. And also they may ask discuss various risk management approaches in financial institution. And another question they may ask, explain comprehensive approach of risk in financial institution. So all these different three questions having only one answer. So here we covered in this second question. So let's start here, risk management and approaches and method. So risk management is very important in the business. Managing risk is we can't avoid risk, but also we can manage the risk. That is a technique and tool where business can use. Okay, so let's see, risk management is a process it is a process identifying, analyzing, evaluating, monitoring and controlling risk to minimize losses and achieve organizational objectives. So here risk management is nothing but it is a process where you can analyze the risk, where identify the risk, where the risk can be get, and analyze the risk, how many different types of risk is going to occur, and evaluating the risk, which risk is very much complicated, which risk give more loss, that risk can be evaluated. Monitoring, we need to manage it. Okay, how we should come with some different techniques to manage such risk, and controlling such risk. And next step is to control that risk should be give us less losses, and also which is going to help for organizational to achieve its objective. Since risk is unavoidable, so here risk cannot be avoided, and in every business activity, organization adapt various approaches and methods to manage it effectively. So here risk management is very important. It is not avoidable, but in every business activity, organization adapt some various approaches and methods to manage such risk in the business, where it can help to manage it effectively. Next, if you see the main objectives of risk management is to control the risk, because here our objective of risk management is to just control the risk, because it is unavoidable factor in any organization. Thus in organization, wherever there is return exists the risk. Wherever you want to have such profits, okay, wherever you want to have high amount of returns, there is a risk. Okay, we cannot avoid this risk, but we need to manage or control this risk. We need to manage it, how means with some different approaches and with some different methods in a business, where you can run it very much or manage it effectively. Okay, so let's see in simple form. So higher expectation of rewards, you expect higher rewards, obviously there will be the higher higher rate of risk chances. Okay, so if you expect higher rewards, next you will be getting the higher level of risk, then you will be getting the higher returns. If you accept lower returns or rewards, there will be the low risk, okay, and low return. So this is the simple form where our organization going to work it, okay, where this risk method is also going to work. Okay, so every business is going to expect highly, so there will be, obviously there will be the risk also very high. We can't avoid, but we can manage it. So let's see, if the returns are higher, then and it's advisable to face high level of risk. The risk is borne by everyone irrespective of whether they are individual, corporate or any society. Okay, so here the higher returns wherever they are, there will be the higher risk happening, chances will be there, and the risk will be happen to for every bond, like any individual or any company, or it may be any society. Okay, so there will be for everyone there will be the risk compulsory. Okay, next we have there are the following various methods and approaches to reduce the risk. Let's see one by one what are the approaches and methods to manage or to reduce our risk, or to just reduce our losses or expenses in a business. Here we have three different approaches and methods. Okay, approaches and method, three different. One is risk control, one is risk financing, and another is internal risk reduction. All these three will be discussing next further clearly. Okay, first one is a risk control. Okay, so risk, we know that already we cannot avoid it. Okay, but we can control it. So it refers to the process of reducing or controlling risk through suitable techniques. How we can control the risk means we should come up with different techniques or different methods or different strategies where you can control such losses and expenses. So that thing we say risk control. And next, if you see here we have two types of risk control. One is risk avoidance and another is loss control. First we'll discuss risk avoidance. Okay, so avoid the thing in which activity you are getting more losses. So that thing we say risk avoidance. Risk avoidance is nothing but the activity is there. In that activity we get n number of chances of losses. Okay, or different type of risk, means you just avoid that activity. So that risk we say risk avoidance. Let's see what they say. Risk avoidance means avoiding activity involves in potential risk. That the activity is there which involves a maximum number of risk it is there. So just avoid that activity. Complete eliminates exposure to a particular risk. Okay, so it is just do it, eliminate is nothing but reduce doing such things. Okay, where you already know which going to occur losses or risk. Okay, just do it, reduce the things. Next method, this method is suitable where the risk is very high. Okay, so this risk avoidance method is very suitable when you know already where there is a lot of chances in your losses of chances in your business. Then you can directly accept it or just avoid the thing, or just go eliminate such things or reduce such things. We say avoidance of risk. So this is suitable when you know already that here there will be the maximum number of risk chances. Okay, next, second you have loss control. Loss control in the risk control. Loss control focuses on reducing both the frequency and severity of losses. Frequency is nothing but the risk, how many times is going to occurs. Okay, again and again until and unless you reach your goal or objective. How many times is in what certain times it is going to occur, that is a frequency. And severity is nothing but how much number of loss, how much loss is going to occur, how much expenses is going to occur until and unless you finish the target. Okay, so that we can control such things, frequency also and severity of losses also. So here we have two different methods in controlling the loss. Here first is a loss prevention and loss reduction. In loss prevention, it aims to stop losses from occurring. Okay, so here what we do, just we stop such losses when it occurs. Okay, so that we say loss prevention. Already you know that loss is going to occur. So here what you are doing means you are doing some activity where you can control such losses in your business. That we say loss prevention. And also it reduces the chances of accident, errors and also failures in such activities. Okay, then you can have that we say as a loss prevention. Here just you are concentrating the things and getting aware that just getting aware and just controlling such things, such activities. And for example, we can say following safety rules to prevent workplace accident. Okay, we are following such basic rules and regulations given provided by the management just protected from such accidents. Okay, if accident occurs means that there will be the number of losses can be occurs, but we are getting aware and preventing such things. Okay, and following such rules and regulations to be safe. Okay, such risks we say loss prevention. This is the method where we can control. And next we have loss reduction. This is the method, risk control method. Okay, loss reduction. What we are doing means we are just reducing such losses. Okay, how it helps means it aims to minimize the impact of losses when they occurs. Here what we are doing, we are maximum losses going to occur, but we are using this tool that which can be minimize such losses. Okay, we are using such techniques where we minimize such losses which are going to occur. Okay, so that we say loss reduction. It helps to reduce the severity of damages. Okay, severity means how much loss exactly we are getting. That is the term we know means that losses can be reduced. Okay, in the business, that we say severity of damages, we can reduce such things. And next, for example, disaster warning system. Okay, reduces casualties during the natural calamities. Okay, so here disaster management system, they give before only awareness that these things is going to happen, be careful and be safe. Okay, because they it helps that management to minimize or to eliminate such losses on expenses occurs. Okay, this is also done in the business. So that is we discuss risk control. Next we have risk financing or loss financing. Second type of method or approach we have risk financing or loss financing. Risk financing refers to arranging funds to cover losses arises from risk. Okay, risk finance is nothing but finance is a term where money we kept, okay, or money we are getting to cover such losses occurs in a business. Okay, so risk financing or loss financing base. Finance is nothing but it is a term of money or a monetary, okay, which is going to help, okay, whenever you get loss or whenever you get risk. Okay, so that amount is going to help to your business to manage such losses. Okay, so that we say risk financing. Here first we have, in this we have two methods, that is a retention and insurance, insurance, hedging and other contractual risk and transfer. Risk financing, in this risk financing we have retention, insurance, hedging and other contractual risk transfer. We are getting finance, we are getting the monetary support from retention or from insurance or from hedging. We'll discuss one by one here. So here risk financing, okay, retention. Retention is the amount where we are keeping aside in a business for whenever the losses occur, so that we can use the such amounts when the losses occurs. Okay, when already you know that such kind of losses or expenses going to occur in such activity or functions, and you are aware that and you are keeping some amount aside, okay, that we say as a retention. Your retention means expected and bearing the risk internally. We are bearing the risk internally and already we are expected means already we are aware about the such types of risk. It is used when the cost of transferring the risk is higher than the potential losses. Okay, the risk is higher and our losses are also higher there. So because of that we are keeping aside such an amount in our business. Here we have two types of retention: active retention and passive retention. Active retention means already we are aware, we are active for that, we are actively participating in such losses or a risk. Okay, so that we say active retention. Passive retention is nothing but we are unaware, okay, but these are a bit dangerous for us because maybe occurs uncertainly. Okay, let's see what is active retention. Active retention occurs when firms knowingly retains a risk. We already know about the risk and we also kept a amount aside. Okay, we are ready for retaining. Next, here organization plans in advance. We are already planning in advance this risk are going to come in our business and we are ready to bear such losses. Okay, so that we say active retention. Okay, and next passive retention. Okay, here we are not giving any attention. Passive attention occurs when the firms fail to identify, we are unable to identify such risk what getting in our future. Okay, we are unable to identify. Okay, due to our negligence or lack of awareness, we don't know anything about such risk, or we are not having any such knowledge. Okay, so for that we say that such risk is going to happen in future. Such risk we say passive retention. It is also cause serious financial problem. Okay, if you are unaware and you are not ready to bear it, okay, and you didn't plan anything, then it is a very much big problem for your financial problem for your company. That is a passive retention. Next you have second method in your risk financing is a insurance. Okay, insurance, already you know the term insurance is nothing but there will be the two parties, insurer and insured. Okay, here we are insured, we are getting insured from the insurance company. Okay, they are giving the surety that whenever losses happens we will help you, and we make them promise that we will pay you premium on time. Okay, so such the agreement between two parties we called insurance. Okay, insurance companies were ready to compensate our business losses. Okay, so that is the term insurance. Let's see here, transfer of risk from the business to the insurance company. I am transferring my company's risk to the insurance company by paying it premium amount to the insurance company. Okay, so let's see here, and the business pay a premium amount. Already I said we are paying the premium amount, and the insurer compensate for covered losses. Okay, and we are compensating our covered losses. We are covering the losses from the insurance company. Insurance helps reduce financial uncertainty, and also this company will be going to help to the businesses to reduce its uncertainty in future. Anything happen, incident means that incident will be taken care by the insurance company. Next term we have hedging. Under risk financing we have third one, that is a hedging. Hedging is nothing but it is a financial instruments where where it have all such things. Okay, like we'll see, it involves using a financial instrument such as forward, future, option and swap to reduce risk. In hedging we have all these terms. Okay, all these financial instruments we say, like future, forward, options, swaps, all these terms, all these instruments we say hedging, where it will help to the business to reduce such risk occurs. Okay, where this hedging will be going to help you for your business losses and risks. Okay, so and also it protects the firm against fluctuation in commodity price. Okay, and also it will be going to protect a business where your commodity price will be fluctuating in a market, increase or a decrease depends on its demand and supply. This hedging will be going to help you. Okay, these all hedging instruments will discuss one by one in the next another question clearly. Okay, about forwards, about futures, options and swaps we are going to discuss in the next upcoming questions clearly. Okay, and next here see hedging how it helps. It stable future cash flows and profits. It help you to keep stable your cash flows and profits in your business. So hedging method and approach is very very important in business and very simple. And next if you see fourth point in risk financing, fourth point is nothing but other contractual risk transfer, and also we can transfer risk to other person by doing the contract. Okay, by having the mutual agreement with the another person. Okay, how you can transfer the risk to another person, let's see. Here risk can be transferred to another party through contractual agreement. You are doing the agreement with that person. Okay, in that agreement clearly mentioned that I am transferring the risk to the other person, where mutual understanding will be there, so going to help it. And next if you see, receiving party agrees to bear the risk in exchange, but they need compensation. They are ready to accept such risk. We are transferring the risk to the other party. Simply why they say that okay, we are ready to take, but pay us compensations. Okay, and also they are ready to take compensation from businesses. Okay, so that why they are going to work. And next one, if you see, such agreements are oftenly called hold harmless agreements. Okay, in such we are transferring the risk from one party to another party. Okay, we say for such things we say hold harmless agreements. Okay, and next if you see, third approach or a third method, we have internal risk reduction. Okay, we discuss risk control. In risk control, risk avoidance and loss control, we discuss risk financing. Under that, retention, insurance, hedging, and other contractual risk transfer. And next we are discussing third approach, that is the internal risk reduction. Here we have two things, diversification and investment in information. Let's see. So here other contractual transfer done. Now we are discussing internal risk reduction. So internal risk reduction is nothing but focusing on minimizing risk through internal business strategies. Okay, what we need to use some strategies and techniques. Okay, internally we are going to find such techniques and we are using in our business to reduce risk. Such we say internal risk reduction. Okay, here we have two things. One is diversification and another is investment in information. Okay, first one, diversification. Diversification is nothing but where for example, all the eggs should not be kept in a one basket. Okay, otherwise if basket fallen down, all eggs will be gone. So heavy losses will be going to occur. Different eggs will be put into the different basket where it will be benefited for you to earn more different way profits. Okay, so that is the thing, diversification. Here see, diversification reduces your risk by spreading investment. Okay, you need to spread your investment in different ways. Okay, in different types of assets, not only in one asset. Okay, so that is the term diversification. You invest in different asset, not only in one actual asset. So here where business activity across different areas, where you can your activity grow in different areas. Okay, and it follows the principle of not depending on a single source. Okay, here we are not dependent on a single source of income, but here we get different things. Okay, because we are investing in various different assets. Okay, so we are not depending on only one thing, and this approach helps reduce the impact of losses in one area. Okay, so here if we have any area losses, but another way we can have the profits and we can manage such losses. Okay, so this area will be going to help in all the certain terms. Okay, and next if you see, investment in information. So this is the thing, last thing, investment in information. Information is also very important to the business. If you have a clear cut information and awareness and knowledge regarding the activities, regarding the losses, regarding the risk, it is very important for the business to manage and control the risk. Okay, so here let's see, information is also how it helps organization invest in collecting and analyzing business information. Organization is always ready to invest such money only to collect information related to the business, how it is going to help to the business. Okay, how it gives some different strategies and techniques to manage all the things, and also it will help to achieve its goal very easily. Okay, so they are ready to invest only to gather the information. And next here how it helps means, it occurs information helps manager make better decision, forecast future and outcomes, and also it is going to help our top managements or managers. Okay, where they can take a better decision about the business. Okay, and also they forecast future, also they know how future can be, again so that how you can get the outcomes also. Okay, depends on your better decision. And next, how information is help means better information reduce uncertainty, improve risk management. So if you have a quality information where it is going to help you to reduce such a uncertainties, okay, reduce difficulties occurs in the future, and also your improves in the risk management. It will also going to help you for the risk management. So here we finished the thing, very important thing we covered, that is risk management and approaches. Okay, here we covered all the different types of risk methods, approaches, techniques regarding the risk. Okay, all these things we covered in only one question, which is very important, maybe asked in several times. Yeah, here we are going to discuss the next another question. Discuss the risk management process, or they may ask, explain the risk management process in financial institutions. Okay, so here in this risk management process we have 4 different steps. Okay, first step is identifying all significant risk. Second step is evaluating the risk exposure. Third step is developing and selecting the appropriate method. And fourth step is implementing and monitoring the performance of risk management program. So here we discuss one by one steps clearly. So first step is identifying significant risk. Okay, here we need to just identify the things. In this we have different methods. First one is a cautionary. Okay, how we identify the risk? In that we first thing what we use means we use a cautionary method, where cautionary method is nothing but we are asking different types of questions to our managers, so that we can get different their responses and feedbacks, which is going to help for eliminate the risk. So here it is opinions and feedback of risk managers are collected and evaluated. Their feedbacks getting collected and evaluated. Second method in identifying significant risk, we have operations and plans. Okay, here operations and plans is nothing but physical investigations of company operations, and plan is conducted. Here just we are doing the investigation about our company's plans and operations. In investigations we get some different kinds of questions and answers, which is going to know about our further coming risk. Okay, so that is the operations and plans we are just going to investigate in the company. And third we use in identifying risk, that is financial statements. Okay, we are just going through our financial statement, we are comparing this year to last year. Financial statements, financial reports are analyzed to identify risk related to stakeholders and our about assets. Okay, so these things are going to identify in financial statements. And next we have things in identifying risk. We go for the next thing, flow charts. Okay, we are just going for the flow charts, just going for the productions, how it happens. Okay, so those things, flows can be identified. Here flow of your stock levels are examined to access possible losses. Okay, production flow is going to we are going to know about our productions and about stock levels, so which are going help us to know possible losses in the future. Next we have historical data. Okay, so here just we are having the historical data. We need to just go through about the historical data now and then how we are doing. Okay, and which will be going to help you to eliminate your losses. Okay, and use to identify the risk. So next step in the process we have evaluate the risk exposure. Okay, let's see what you mean by risk exposure. In this risk exposure, nothing but in this we have frequency and severity of losses. So already I told you about frequency and severity of losses. Okay, are predicted. Loss frequency means likelihood of losses occurring, how many times of losses going to occur in a business. Okay, certain types of risk, how many times is going to occur. Okay, and loss severity is nothing but magnitude of losses that may occurs. Okay, how much of loss going to occur, that is the magnitude we say. Okay, so this is the thing, this is the second step where we where we are risk exposure. First we identified, next risk exposures. Third step is develop and select appropriate method. After identifying and evaluating the risk, next come for the development of your the method, appropriate method. What you came with method, that method will be developed properly. Okay, the most suitable risk management method or combination of method is selected. Most suitable method is selected. We came up some different methods and techniques, okay, to avoid the risk, but one is selected from that most. Okay, so that is the development and appropriate of risk method. Next, fourth step, we have implement and monitor the risk management program. Now one method we are selected or technique we are selected to manage the risk, that technique is implemented in the business and that implemented will be controlled. Okay, so we are keeping on control and such things. Okay, here what you do means risk management policy statement. Okay, here what we define our objectives, policies, responsibilities, procedures and risk management. Okay, in the implementation we need to concentrate on our objectives, policies, responsibilities. Okay, so and we need to manage and we need to control such things in our risk management policies. And next we have, okay, and in the fourth step we have cooperation with other departments, and also we need to cooperate with our other departments in the company. Different types of department and functions will be happens, so coordination and cooperation is very important for implementing and controlling the things. So here coordination among all the departments help identifying the risk effectively. And next we have periodical review. Periodical review is nothing but regular assessment of your risk management programs, safe measures and risk related cost is conducted. Here nothing but what we are doing means all the assessments we are going and just we are seeing is it safe, is it measurable, and risk related cost is also we are going to concentrate, which are going to conducted in the business. Okay, so this is the thing, this is the question we covered, risk management process. Very simple thing where it is a maximum chances of coming question is to come in your exam. Maximum chances is there and very important. So all four steps we covered very easily. And next question is what is liquidity risk? Very simple, this is for the short answer, liquidity risk. Okay, already we discussed about liquidity. Okay, the liquidity is nothing but the asset which is easily converted into cash. Okay, but the asset is not ready to convert easily into cash, then you will be going to have a liquidity risk. Okay, let's see what it say. When a firm is unable to purchase or sell a particular product within a short span of time, okay, being its value is unchanged, then it is referred as a liquidity risk. Okay, that asset is not ready to convert into cash and we are not able to sell or buy in a business. Okay, so such situations we face liquidity risk. In order to operate business smoothly, it is very essential for the any firm to possess liquid fund. Okay, so our business should run very smoothly. Okay, all the information should go on smoothly, then we should have a liquidity funds in our business. If it is not available on time, then we are going to face such a risk. Okay, so here the assets which are illiquid possess highly liquidity risk. Illiquid means the assets which are not liquid, so they are going to face some liquidity risk. Okay, so this is the very small topic on liquidity risk. Nothing, they will ask for the short question and you need to write clearly. And next question we are going to discuss about, describe briefly about the different types of capital market risk and product market risk. Very important, we need to discuss the types of capital market and product market risk, different type of capital market risk and different type of product market risk. Let's discuss one by one. Okay, or they may ask different types of product market risk and capital market, or they may ask capital market risk, or they may ask product market risk. These types of question arise in exam, many different appears last 2 to 3 times. Okay, very important according to the exam point of view. We'll discuss these two types clearly. First one, capital market risk. Okay, first of all, understanding capital market is very very important. Capital market is nothing but where you purchase sales such as a shares, bonds, debentures, okay, different types of securities where you purchase and sell. Such market we say capital market, like NSS. Okay, so different markets were available where you can buy and sell. So those BSE, okay, Bombay Stock Exchange, okay, National Stock Exchange, these markets we say capital markets. Okay, so let's discuss its types. So first of all, what is a capital market? It refers to the risk associated with investments in capital market. Already I said you what is a capital market, where you get such risk, such type of risk as said as a capital market risk. Okay, the classifications will discuss one by one. Here we have capital market risk. Okay, these are the classification. Like first one is a market risk, industry risk, regulatory risk, business risk, interest risk, liquidity risk and product risk. We'll discuss one by one simply. Okay, so here we have market risk. Risk arrives due to fluctuation in interest rates. Okay, so like equity price, foreign exchange rates, commodity price, it is also known as a systematic or a beta risk. Okay, nothing but market risk is nothing but already we are in market, okay, trading such as securities or a stock. So where there is a fluctuation in such conditions, fluctuations in our interest rate, where we get more interest but our interest rate reduce, we get less interest. Okay, our equity prices, okay, get less, okay, get reduced, then we get less benefit. Foreign exchange rate, fluctuation in foreign exchange rate, commodity prices will be also vary. Okay, so because of that we face systematic or beta risk. Okay, and next we have industry risks. Industry risks is nothing but risk caused by factors affecting a particular industry. Okay, factors affecting by a particular industry. What are the factors? Such as price variations, regulatory changes and changes in interest rates. Okay, in such industry, if there are the changes in such factors, we say industry risk. Okay, regulatory risk is nothing but risk arises from changes in regulatory laws. Okay, there is a change in regulatory laws and licensing requirements, and there may be affect the operation of financial institutions. Some rules and regulations changed by the government. Okay, and we need to adapt. Okay, so the rules regarding our laws, our licensing. Okay, so this is going to affect our operational by the financial institutions like banks and all. Okay, and next we have business risk. Now what risk? So the things which business risk is nothing but the risk that a line of business may become obsolete or loss its competitive advantage due to competition or technological changes. Okay, when business risk when we occurs business risk means when we are unable to face the competition, when we are unable to adapt the newly technologies. Okay, at that time we are going to face a business risk. Okay, and next we have interest rate risk. Okay, if there is a decrease in interest rate, okay, where we are getting the highly interest rates on our amount, but now there is a changes in such interest rates. So such changes in the fluctuating in such interest rates, or we are paying the interest but the interest become high, the rate become high and we need to pay now high amount of interest. So such interest, such fluctuations we say interest rate risk. Okay, so interest rate is fluctuation in our interest rate which going to affect the financial assets and liabilities in a company. And next we have, okay, liquidity risk. Okay, the liquidity risk is nothing but risk of inability to meet financial obligations. Okay, so what is the type of liquidity risk is already we discussed. Okay, in short answer also, so they are not meet financial obligations. Okay, withdrawal demands due to insufficient liquid fund. Okay, we are don't have such a, we are having insufficient liquid fund because our assets are not easily getting sale or we are not easily buying such things. Okay, so that we face a liquidity risk. Next we have product risk. Okay, when we have product risk means when we are not updating our product, we get a product risk. Okay, So like a product may become obsolete or less competitive because of innovation and technological advancement. So product risk means we need to concentrate on products, some newly things, some we need to add some extra features, characters in our product. Okay, we need to add up some newly technologies. Then if we add up all those things, we won't get product risks. Otherwise we will be facing such product risk in our business. So next we have, so this is the regarding about capital market risk. Next we'll go for the product market risk. Okay, already we know what is the products. Okay, here products are different in the different in investments. Okay, so product market risk, we'll just see the meaning here. It is the risk refers to the risk faced by many firms offering product and services in the market. We are offering products and the services in the market. Okay, like we buy and sell the shares. Okay, products are nothing but it may be shares, it may be securities, it may be futures, options. Okay, available in the market. So the things where we are getting some risk, we say as a product market risk. Okay, these risks are related to operational and strategic aspect of managing revenues and expenses. Okay, they are related to our operationals. Okay, our strategy is related things, and also we manage our revenues and expenses clearly. Okay, now here we discuss what are the different types of products available in a market. Okay, so what are the risk you face in a market. So here we have, so product market risk, we have product market risk. First we have credit default risk, basic risk, settlement risk, currency risk, foreign exchange risk, commodity risk. And in foreign exchange risk we have transactional exposure, translation exposure, economic exposure. We discuss one by one thing. So first one is a credit or default risk. Already we know credit or default risk, what it means. Credit means the amount which is unable to get from the party for whom we gave. Okay, so here credit risk is nothing but risk borrower may be unable or unwilling to repay your borrowed amount, causing losses to the to your lender. Lender is nothing but we are the people that for us we are not getting the amount back where we gave. And second type we have basic risk. In basic risk it is generally getting arise. So risk arises from variation in interest rates and changes in the relationship between comparable securities, reducing hedging effectiveness. Okay, basic risks are getting arises because of changes in some interest rates. Okay, and we are comparing some different things and we are getting some less things. Okay, comparing the securities and reducing in your hedging effectively. Okay, so that base for that certain changes or relations or comparables we say basic risk. Okay, and so next risk is a settlement risk. Okay, settlement risk where at the time of settlements we get some amount less. Okay, at the time of settlement where the parties are not able to ready to pay, but at the time of settlement he is ready to pay half or some amount. That amount we say settlement, but the other remaining amount we say settlement risk. Okay, the risk occurs due to settlement of financial transactions such as money transfer, check clearance, and loan disbursement and interbank transfer. Okay, at the time of money transfer or check clearance. Okay, so all those things we face here settlement risk. Next we have currency risk. Okay, when there is a fluctuate in the exchange rate or fluctuation in the currency value, we face currency risk. Okay, so risk caused by fluctuation or exchange rate between different countries affect financial position and asset value. Immediately the changes in the currency rate or exchange rate, immediately it is going to affect to our financial performance and our company's asset value. Next we have foreign exchange risk. Okay, so here in foreign exchange risk we have different types. Foreign exchange risk, let's know the meaning. A risk arising from the foreign exchange rate fluctuations in international business operation. Okay, so here the risk is arising from the foreign exchange rate and there is a fluctuation, you are getting the fluctuation where you are doing international business. Okay, at the international business operation, at that time the risk occurs, we say foreign exchange rate. Okay, here we have three terms. First one is a transactional exposure. Okay, already we discussed all these things. Transactional exposure is nothing but risk affecting payments and receipt in foreign currency transaction. Okay, where we do payments, okay, and we get payments and receipt where the values can be reduced. Okay, in such transaction we say transactional exposure. Next, translation exposure. A risk arises when foreign financial statements are converted into domestic currency, when their payments is converted into our domestic currency. Okay, if there is a change in currency value, we face transactional exposure. Next, we have economic exposure, risk affecting future cash flows and competitiveness due to exchange rate changes. Already these three things we covered in last questions. Once again you can go through. Next, we have commodity risk. So commodity risk is nothing but resulting from fluctuation in commodity prices such as oil, agricultural products, raw material, affecting profitability and asset values. When there is a change in the commodities, okay, here what are the commodities example they gave means your agricultural product, raw material, affecting the profitability and asset values. If there is a change in such commodities, there will be the going to affect in a company in your asset value. So that thing we say commodity risk. So here we finish your the last question regarding types of capital market risk and product market risk. We explained clearly. So both the types of risk we covered, capital market and as well as product market risk. Okay, so here we finish your first unit, last minute revision. You can go through. Now we'll start second unit, measurement and management of risk. Okay, important questions. Before that, I want to tell dear students, all the notes and material is available in SIA LMR app. Please download it from Play Store and go through all the notes. Very important for your last minute revision, and also you will be getting there all previous year question papers, which is going to help you more in your exam. So let's start second unit. First question, explain non-insurance method risk management process, and they may ask discuss the non-insurance method or risk management, or they may ask discuss briefly the non-insurance method and risk management. So all three questions, different questions, but similar answers we are going to cover. So here if you see, let's discuss the risk avoidance and risk retention and risk transfer. Okay, so non-insurance method of risk management. Okay, non-insurance method is nothing but insurance. If we do means the compensation of losses will be done by the insurance company, but if your non-insurance method means we need to keep aside of our business fund separately to face the future losses and risk. Okay, so here we'll see what are the things are there. So first here risk avoidance, already we discussed risk avoidance. Okay, what you mean by risk avoidance? Avoiding the such activities where risk is involved. Okay, under this method assets or activity causing potential losses is abundant. Whatever the asset or activity, if we know the risk or losses caused, we need to stop it there. Okay, abundant is nothing but just eliminate it, and this technique is suitable when the losses is known and not much serious. Okay, when we know about the losses, we can stop such doing things. Okay, and it is not much serious also because we are aware about our future things. Okay, so here this is the first thing. And next here we have risk transfer. Okay, in the risk transfer it involves shifting the risk to another party. This method of risk are under the risk transfer we have some different methods. Okay, risk transfer is nothing but shifting the risk from one party to another party. So here first we have hedging. Okay, hedging is nothing but already we discussed, this is the financial instruments where we have all the things like forwards, futures, options, swaps. Okay, hedging will be going to help you to transfer your risk, okay, by reducing exposure to potential losses. Okay, and also it involves giving up part of the possible gain in order to reduce the risk. Hedging also provide you the part of possible benefits or profits. If you go for the hedging, it will be going to help you, and where you can also manage your risk. Next we have insuring. Okay, so insurance also we discussed. Insurance is nothing but it is substitute a certain small loss premium for the possibility of a larger losses. We discussed about insurance company. We promise them that we will pay you the premium amount, and they will promise us they will compensate our losses. Okay, so for example, paying an insurance premium to protect against our damage or theft to the insurance company. Okay, so that is a insurance. Next we have diversifying. Okay, diversifying also we already discussed about diversifying. Diversifying is nothing but I already told that all the eggs should not be kept in a one basket, it should be kept in different basket. Okay, so same thing, diversifying, our amount is there, fund is there in our company, means we need to invest in different assets and different securities. If one it get lost, but we can get benefits from other, we can cover and we can manage such risk and losses. Okay, so and next we have risk aversion. Okay, risk aversion is nothing but here what we need to do means selecting the risky alternatives among available investment options. Okay, so different risky alternatives we need to go through, and which one is less risk we need to select it and we need to invest. Such things we say risk aversion. Okay, and also investor prefer project with lower risk. Everyone will go for the lower risk only, but expected high returns. It will be going to be giving you high returns. Okay, so risk aversion will be help in such manner. And next you have loss control. Okay, how you will be going to control the losses. Already we know, basically we discuss about loss control also. It add up to when risk cannot be avoided. Okay, so we cannot avoid the risk, so at that time we need to go for the loss control. What are the objectives of your loss control? Okay, so here objectives are if you of your loss control: loss prevention and loss reduction. Reduces the frequency of losses, minimize the severity of losses. So next here we have types of loss control. Already these two also we discussed in the first unit, you can go through. So types of loss control. Severity reduction, it is nothing but reducing the seriousness of losses. Example, airbags in cars reduces the injuries during the accident. Very simple example, you can understand clearly. So this is the severity reduction. Okay, we cannot avoid, but we can control. Okay, and next we have separations. Okay, separation is nothing but involves reducing the amount of loss associated with specific risk by separating assets or operations. Okay, we are reducing the losses. Okay, so if we do the separate means it is very easy for us to reduce such losses, specific risk, by separating our assets and operations in our business. Okay, and next we have duplications. Okay, duplications is nothing but if any assets or the material is available which is going to help for replacement of the current running assets. Okay, so duplication is nothing but equipment and resources are maintained to replace for damaged items. Okay, so that we say duplication, where the lost assets will be going to help for the working assets. Okay, we can replace that material. Okay, next we have timing of loss control. So we have three types of timing of loss control. First is a pre-loss activity. Okay, pre-loss here loss control measures implemented before loss occurs. What we do means pre-loss is nothing but we are controlling it before it occurs. That we say pre-loss activity. Current loss control. Okay, current loss control is nothing but when it occurs, on that present we control. Okay, such control we say current loss control. Next we have post loss control. Already loss has been occurred, now we are trying to control that loss. Okay, when loss occurred. Okay, such control we say post loss activity. Okay, next we have risk retention. Risk retention is nothing but already we discussed, it is a non-insurance method in which organization retain part of all the losses arises from risk exposure. Losses are made from the firm's income, reserves, funds and bank overdraft. So all the losses has been covered, okay, with the help of how means with the help of our incomes, reserve funds and our bank overdrafts, okay. So the insurance company is not going to help you here. Here you yourself, from your company's profits, company's incomes, you need to cover the losses, such we say risk retention, okay. So that is the opposite for your insurance. And next we have types of retention, okay. Let's see what are the types of retention. Planned retention, risk is recognized in advance and conscious efforts made to bear the losses. If we need to identify and recognize it in advance, so we can bear such losses. It is widely used because it convenience. So this method has been widely used in the company because it is very convenience. Next, unplanned retention, okay. So occurs when risk is not properly recognized. Unplanned retention is nothing but we are not aware about it properly, okay. Our losses are underestimated, okay. We took it very lightly, okay. So such time losses will be underestimated in a company. Next term we have unfunded retention. Unfunded retention means we doesn't kept any fund in a business for the upcoming losses, okay. Such funds we say unfunded retentions. Funded retentions, already we kept aside from the profit, we kept such amount, okay, from or any expense or from any reserves, we have some fund, okay. So those funds we say fund retention. To face such losses and expenses, we kept aside such funds from any our in business incomes, okay. So these so here I finish the question, which is very very important, first question in your second unit, okay. So what is that question, we'll see once again. So we cover all about risk avoidance, risk retention and risk transfer. All these things we covered just now. We'll go for the next question. Yeah, discuss the concept of ALM and various guidelines issued by RBI towards ALM. Very very important. ALM is nothing but asset liability management. Or they may ask, discuss the significance and applicability of ALM system. Or they may ask, describe the RBI guidelines in the process of ALM practices. All these three questions are repeatedly occurs in exams. So it will be very helpful for you. We'll discuss the things about ALM. Or they may ask like, discuss the RBI guidelines in relation to ALM. All the questions related to ALM we cover here. So here what is the answer means, the concept of ALM, already I said ALM is nothing but asset liability management. Asset liability management, managing the both asset and liability is very very important for the business, okay. It will help to increase its business values, okay. So ALM is deal with which is going to help you for the long term purpose of your business, okay. Long term management of a financial institutions like your assets and liabilities. It manages risk arising from variations in interest rate, exchange rate, liquidity position, credit risk and contingency risk. So it will going to help you to manage the risk from all these aspects, interest rate, exchange, okay, and contingency risk. And also ALM is gained importance in a financial institution. During the let's see how it ALM helps. During the 1990s, due to significant change in financial sector affect the balance sheet items, okay. Here the ALM concept has been used from 1990 because there is a change in financial systems and all. So from that time we use this ALM concept. So here how the RBI guidelines with the significance of ALM. RBI helps it emphasize to combined risk management system for banks. ALM provides a structural framework to identifying, measuring, monitoring and controlling various bank risks. So RBI gave this method, so where this ALM will be going to help for the financial institution for their it will be giving the structured framework. Okay, in that they identify, they measure, they monitor, they control and of about your various banking risk, which will be going to help you to eliminate the banking risk. Okay, the major objective of RBI guidelines are, so on this ALM, RBI guide about managing liquidity risk, already we know liquidity risk, managing interest rate risk, supporting risk measurement and analysis, assisting in effective asset liability and management, ensure proper risk control and supervision. So all these are the objectives, okay, where RBI providing for the ALM. Okay, and next we have support system of ALM. Okay, how ALM is going to support for the financial institution. Financial institutions are nothing but banks. Okay, so how this is supporting system means, first one is a information ALM. Information ALM means nothing but overall full information regarding asset and liability, which is going to help for the banks. Okay, so it is plays a vital role ALM process by providing accurate and timely information regarding the risk. Okay, so where it gives accurate and timely information regarding risk to the banks. Okay, and next how it how it help means, it define risk policies and tolerance level. Okay, so also ALM help the bank risk policies, tolerance levels, it will inform to the bank well in advance. Maintain complete asset liability information, very easy. Supports risk measurement and decision making, very easy. Provide information required for capital adequacy and market risk evaluation. Okay, so in these all things the ALM is going to help for the financial institution. Okay, next we have how this organization of ALM. Okay, organization of ALM focuses on management structure responsible for risk management. It is responsible for risk management. It has a proper management structure. Okay, next here we have asset liability management committee. Okay, ALCO, very important. ALCO is responsible for formulating business strategy and managing risk. Okay, it consists of senior management members including the CEOs, CMD, executive directors. Okay, so here they have all the top managements. Okay, where they are where this ALM committee is formed with all these members. Next, the committee evaluates the market development and risk profiles. Okay, so what these members they do means, they evaluate the market development and they come to know about their risk. It measures liquidity and interest rate risk. Already we are clear with all these words. Okay, and next if you see means, it functions a decision making body for maintaining balance sheet planning from a risk return perspective. Okay, it is also help for better decision making. Okay, and balance sheet planning from a risk return perspective. Okay, so again if you see means, here is a process of ALM. Okay, excuse me, asset liability management process. If you see means, here we have 5 steps. How it will help means, managing liquid risk. Okay, already we know about liquid risk. Managing market risk we know, including interest risk, that also we know. Planning for funding and capital requirements, it will also help for capital requirements. It will also plan for forecast growth, profitability. Okay, and next managing bidding risk. Okay, so these are the steps under ALM, very simple. Okay, next we'll go for the next question, that is what is VAR? Explain how VAR helps in investment decision, how VAR different from CAR. Very important question. VAR and CAR, relating to these two we cover all the things. Okay, relating VAR and CAR we are going to cover in the next question. I'm so sorry. So here we'll discuss VAR and CAR, very repeated question about VAR and CAR. So let's discuss what you mean by VAR. VAR is nothing but value at risk. Okay, so here VAR is the risk management concept. used by top management to measure the short term price risk. Okay, very simple. It is a concept used by top management to measure the short term price risk faced by firm through a single number. Okay, it is very important, through a single number, VAR. Okay, you are measuring the short term price risk through a single number. Okay, you invested crores of amount. Okay, but crores of amounts, there may be 1 lakh of risk. Okay, this is very single number. It describes the risk in a single number. Okay, crores of rupees if you are invested. Okay, 10 crore rupees you invested means 1 lakh amount is very small in front of 10 crores. Okay, it tells in a single digit number 1 lakh is risky in such circumstances. Okay, so that we say VAR. Originated from a requested by JP Morgan's, okay, chairman's Dennis Featherstone's for daily report on the firm's risk exposure. Okay, so these are the persons who developed this VAR. Okay, later it become a standard financial industry tools. Okay, for measuring price risk and BIS. Okay, recommend it use in bank in 1995 for capital adequacy purpose. Okay, so it helps for measuring the price risk and BIS, which is used in such banks in 1995. Okay, so if we discuss here, and next thing related to VAR we'll discuss here. Okay, so VAR estimate the potential price risk, okay, arises from portfolios of derivatives, okay, and other financial assets. Okay, so VAR, which is going to find you the price risks, okay, from all the portfolios, from different derivatives. Derivatives is nothing but value of assets, okay, and other financial assets. Okay, it indicates minimum expected amount by which portfolio value may fluctuates. Okay, so minimum amount, it will tell you how much risk is there. Okay, you are going to face accurately in the portfolio value. Okay, how much getting fluctuation in your portfolio, that is going to tell by VAR. Okay, and if you see VAR in investment decision. Okay, very important how VAR is going to help you in investment decision. Okay, so VAR in investment decision. VAR helps firms measures and managing investment risk. It is very important. It helps firms to manage it investment risk. Okay, it useful when firms value is important for raising funds from capital market. When you want to raise your funds, investment funds in a capital market, it will help you to know. Okay, next, firms may use VAR to decide whether or raise funds or sell assets or reduce investment when cash flow are insufficient. Okay, here it will help for the firms, okay, whether to raise, whether to sell, okay, whether to reduce your investments, okay, to maintain your cash flow. Okay, and next, higher firm value improves access to capital market. Okay, so also it will improve your accessing to the capital market, while risk to firm value reduces the present value of future cash, the present value of your future cash flow, and also it will reduce the risk for your present value of your cash flow. Next, banks commonly use VAR to measure the market risk, okay, with the help of 5% probability level. So these things will be used by majorly by the bank by thinking probability 5% of level of risk. Okay, then non-financial firms, how they may use means accessing risk in derivative market. For the non-financial firms, how it will useful means it will be helps in different derivative markets. Okay, next, if you discuss next we'll discuss the difference between value at risk and cash flow at risk, VAR and CAR. Okay, very important question. So here we'll see what are the difference between VAR and CAR. First, uses. Okay, how it uses. VAR is used, okay, to measure the risk. Already we know, first applied to single transaction and then added to all the other transaction to arrive at another organizational level. So here VAR in meaning only we discuss, it will tell you a single person in a single digit amount, single digit number, it will tell you the loss going to occur, the rate of losses. Okay, in cash flow it will be, the risk is used to find the difference between the expected cash flow and released cash flow. It is nothing but expected, what we expected and how much we got. Okay, so what we expected and how much it is cash flow fund is there. Okay, the difference between both of the thing will be tell by the cash flow. Okay, the difference what we get, okay, that we say that is a risk if it decreased. Okay, next if you see measurement, how it can be measured. So measured by using a statistical method. Okay, standard deviation. So we think 5%. Okay, with statistical number is 1.65 standard deviation from the expected value. Okay, 5% of probability losses we take it in the measurement of this VAR. But here 5% of significance of probability, it is indicated as a P. According to this firm are expected to face lower amount of cash flow shortfall. Okay, 95% will be the benefited here and 5% will be said as a 5% will be said as a risk or a chances of going to be having the losses, 5%. Okay, but 95% is going to be benefited for here. And next if you see the third difference, value of cash flow. Okay, so here VAR cannot be determined changes in the value of cash flow. Here VAR will be not going to help you if there is any change in cash flow. Okay, but CAR is significantly used, okay, to know changes in the value of cash flow. Obviously CAR will be going to help you if there is a change in any cash flow. Applied to companies. Okay, we'll see VAR is relative for financial companies like banks. CAR is important, useful for non-financial companies like businesses and other industries companies. So these are the difference between, we covered overall about VAR and CAR. And this is the next question. Explain the evaluation and concept of assets, liability and management, or they may ask what is ALM. Explain the evaluation process of ALM. Okay, asset and liability management. So already we discussed what you mean by ALM. Okay, we'll discuss the concept. ALM, asset and liability management, deals with the effective long term management of financial institution. Okay, so it is already we know it is going to help you for the long term in financial institution like banks. Okay, it manage risk arises from variation in interest rate, already we know, exchange rate, liquidity position, credit risk and contingency risk. Already I discussed the importance of ALM increased after, already we know, after 1990s. Okay, because there is a change in such a balance sheet items. Already this also we know. The concept and evaluation of ALM. Okay, after the liberalization, rapidly industrial growth increases. So after we know we got a freedom, okay, to set up the industries and business. So there is a growth in our industries and fund requirements and loan demand has started there. Okay, traditionally banks managed fund according to the interest rate. They used to manage traditionally before at the time. So bank used to manage it with the help of interest rate. But deregularization and growing competition changed bank practices. Okay, again there will be the changes in such bank practices because of, again there is a certain change in rules and regulation. The need to match the maturity of assets and liability, managing interest rate fluctuations and control risk exposure leads to emerging of ALM. Okay, so these all are the factors which helps to comes this term ALM. Okay, so this is the concept of evaluation. Next we discuss reasons of the emerging and importance of ALM. Okay, so here volatility. So reasons is, first is a volatility. Volatility is nothing but there is a frequently changes in the values. Okay, values of shares or any securities ups and downs in the such values, we say volatility. Here globalization and free movements of economics increased market volatility. Why markets prices going to ups and downs frequently? Because there is a free movements and economics because of this globalization. Okay, volatility get fluctuation. Next, change in interest rates, exchange rates, money supply and credit condition affects banks. Okay, so why this ALM concept came means because of in changing in interest rate, exchange rate, money supply and credit rate, this used to create a much more risk. Okay, because of that ALM will be going to help in the company to reduce the risk from all these changes in such factors. Next, variation in exchange risk influence market values and cost of funds and sources of funds. Variation is nothing but changes in all these terms. Okay, it is very difficult to add up for the business and companies. Okay, so because of that the ALM will be going to help for the businesses. Next, we have continuous monitoring of these exchange become necessary. Okay, so here it will be going to help the companies for continuous monitoring. Okay, and which is very necessary, increasing the importance of ALM. This will be going to increase importance of ALM in such companies. Next, we have introduction of new product. So introduction of new product, it is kitna minute हुआ sir? Yeah, introduction of new product, rapid innovation in financial product increased the need of ALM. So rapidly increase in financial products, so we need ALM. Bank introduce new products and modified existing products. Okay, meet market requirements, we need ALM. Early withdrawal of deposits. Okay, so ALM concepts is very helpful for early withdrawing from the banks. Okay, changing in because of there is a change in customer preferences. Okay, created asset and liability mismatches, ALM is going to help. And next we have these situations increases liquidity and interest rate risk, making ALM essential. So ALM concept will be help here to increase the our liquidity. Okay, so interest rate and making ALM essential, very essential. Next, third point, we have regulatory environment. Okay, so regulatory environment, how ALM is going to help means in integration of domestic and international market, increase regulatory requirements. Okay, so domestic and international market where it is going to always require this both the market, so ALM is going to help in such side. BIS introduce regulatory framework for managing market and price fluctuation risk. Okay, BIS is nothing but banks for international settlements. Okay, for this international settlement also ALM gives much benefited for managing market and price fluctuation risk. And also RBI encourage bank to develop ALM policies and guidelines. Next, risk based audit systems were also introduced, strengthen risk management. Okay, so these are the things where regulatory environment helps. And next we have fourth point, awareness of about our top management. So there should be the awareness for our top management regarding ALM. So what are such awareness should be there? To management of recognize the need for effective management assets and liability. We should be aware about the ALM. Okay, to manage assets and liability effectively in our company. Bank realize the growth in deposit and credit distributions along with insufficient. Okay, we also should aware about the this growth in our deposits and distribution was where it was insufficient. And next, proper matching about assets and liabilities because necessary for effective financial management, and this is also very much important for proper managing our assets and there should be match. Okay, there should be tally between assets and liability. These increases the adoption of importance of ALM. All these concepts were help which make to come this importance of ALM in our companies. So here we finish the last question. We'll start for the next question. What are the different methods used in computation of VAR? Already we discussed about VAR and CAR. Let's discuss what are the different methods are there, okay, to know the VAR. Okay, so here we have three methods: variance covariance approach, simulation method, Monte Carlo simulation method. Okay, let's discuss one by one. Variance covariance approach. Variance covariance approach. Okay, the approach is also known as delta normal method. It is followed by JP Morgan's risk matrix model. Okay, so this variance also known as a delta normal method. It has been established by JP Morgan's for the risk matrix model. It assumes that asset returns follow a normal distribution. There will be the, in calculation there will be the normal distribution. Expected value variance are used to determine VAR, what we accepted value. Okay, so that value will be help us to know our value at risk. Portfolio variance is calculated using asset variance and correlation. Our portfolio value is also coming to know with the help of variance and covariance. And next we have steps involved in VAR under variance and covariance approach. What are the steps? We'll discuss one by one. First step is estimating the variance of portfolio returns daily, weekly or monthly. So first step where we come to know the variance of portfolio daily, weekly and monthly. Okay, so let's discuss. And second step we have estimating the losses in the value of portfolio for given period. We just estimate, we also come to know value of losses for the given period. It may be 1 month, 1 year. In this method, variance of assets return or return covariance are calculated using historical data. Historical data will be going to help for to know the your portfolio value of risk. Next, reason for using the value changes instead of percentage changes. We are using the value change. So what is the reason? Derivative contracts are marked to market and percentage returns cannot be calculated accurately. Here we are not getting the percentage accurately into the market. So because of that we use value change instead of percentage. Most derivatives are liabilities and therefore possess negative values. So because of that also we use this value change. Okay, next we have fundamental sources of asset value volatility. Okay, here we have interest volatility. When it happens, volatility is nothing but frequently changes ups and downs in the values of assets. Okay, so it may be interest rate. Why it can be changed means interest rate, because of interest rate, time maturity, spot exchange rate, stock market factor and commodity prices. Already we know all these basic things. Okay, next step we have simulation method. Okay, next method of VAR calculation we have simulation method. It is nothing but examines the effect of various risk on bank financial position. It will help us to know what is the risk, okay, will be coming to our bank's positions, how much risk we are going to face, okay, or financial position where we lack, okay, like asset value and earnings and net income. Okay, so these things we will be coming to know with the help of simulation method. Statistical simulation, that first one we have statistical simulation method. It is nothing but current on balance sheet, off balance sheet positions are valued. Okay, current balance sheet and off balance sheet, which is upcoming balance sheet, both the balance sheet as will be valued with the help of this simulation method. Focuses on present value position. Okay, we just focus on present, not future and past in the simulation method. Okay, next we have dynamic simulation. Okay, it creates assumption about future interest. Okay, assumption about future interest rate changes in banking operation. We just assume we go for the assumption rate. Okay, so that we say dynamic simulation. Next, output varies according to the user requirement. Okay, output will be the different you will be getting according to your requirement. Next we have simulation techniques provides. So what are the techniques it provides? Okay, current and expected periodical gap. Okay, what is the current result and what your expected result, those gap will be provided. Duration gap, how much duration, at what you expected the duration, okay, how much gap it is to achieve your target. Balance sheet and income statement, performance measures, okay, budget and financial reports. Okay, so all these things will be these are the techniques will be helpful in the simulation. Okay, and simulation identify the risk exposure under different interest rate and balance sheet scenarios. Okay, so next method we have Monte Carlo simulation method. Okay, so it is nothing but Monte Carlo is a person gave the simulation method approaches to generate probability distribution for fluctuations in portfolio value. This method will be help you to know the probability distribution fluctuations in your portfolio values, how much it is fluctuated. Okay, how much your portfolio value increased or decreased. With the help of this Monte Carlo we will be coming to know. Okay, and next it will help, how it help means it values the portfolio using percentage value and market variable. Okay, use multivariate normal probability distribution, and there will be also a normal probability distribution, helps estimate one day VR for portfolio. Okay, and also it will help you for the one day portfolio. Okay, and also it is known for the partial simulation method. Half of the things of the simulation method will be applicable in Monte Carlo simulation methods. Okay, it is a partial to your simulation method. Partial means half of the things on techniques will be added here. Okay, so that is the third method. Okay, so here I finish your variance, different methods of variance. Okay, different approaches in variance, we finished your question. Okay, so if you want, the dear students, if you want to go through for the clear and complete notes and complete material, please install CI LMR app from the Play Store, where it will be going to help you for preparing your overall exams, and will be also provided overall last previous year question papers also. So please go through for CI LMR app. And next question we discuss, a portfolio has 3 assets with market value. Okay, so this is the problematic question, but simple. If you remember the formula, that is enough. Okay, so here we have stock, we have bond, we have currency. Okay, and this is the question, and they gave and the variance and covariance matrix is below. Okay, so they gave variance and covariance. We discussed just now about variance and covariance. So this is the matrix they given in the question. Okay, swap we have, bound we have, stocks we have. Okay, so here you are required to find the value at risk. Find the value at risk of the portfolio. Okay, very simple. Okay, we'll start answer. So here we have solution. The value of swap currency swap is 20 lakhs. Okay, or 8.7%. You calculate all these things. Okay, and then you just divide this amount, you will get 8.7%. Okay, 2 crores 30 lakhs will be the total amount. If you divide this 20 lakhs divided by 2 crores 30 lakhs, you will be getting 8.7 of the total portfolio value. And next you will be having the value of bound is 1.770 crore. Okay, so the percentage of total portfolio value will be over 73%. Okay, it will be having 73%. The value of 10,000 shares, okay, 40 lakhs, it is having the 17% of your portfolio value. Okay, so these are the portfolio value we founded out. Now calculating the VAR, very important formula. This is the very important formula. Remember the formula, VAR is equal to W1 square okay, standard deviation 1 square plus 2 W2 standard deviation 2 square plus W3 standard deviation 3 square plus W1 W2 and standard deviation 1 2 plus 2 W1 W3 standard deviation 1 3 plus 2 W2 W3 standard deviation 2 3. This is the formula, and now we will calculate W1 W2 and standard deviation 1 and standard deviation 2, okay, where W1 is 88.7% of the portfolio. So W1 is this, W2 is your bound value, that is 0.73, 73.9 if you do, you will be getting 0.73, and W3 it is a your swap value, that is 17%, okay. So this is the value of your stock, that is a 17.4. so that if you divide 17.4 divided by 100, you will be getting 0.14. next standard deviation 1, that is 0.900, standard deviation 2, that is 0.44, the 00040. next you have standard deviation 3, 0.0030. next you have standard deviation 1 2, standard deviation 1 2 is nothing but bound, minus 0.408. next you have standard deviation 1 3 is nothing but 0.0007, and next 2 and 3 is nothing but minus 0.0010. next you keep this formula and set the all the values, okay. if you calculate in this formula, you will be getting value at rate 0.0028. so 0.008, and next you need to remove its square root, you will be getting 0.00167 or 1.67%, okay. so that is the simple problem with solution, okay. next we have explain the management interest rate risk with its different types, okay. now we are discussing the another question, management of interest rate risk and its different types, okay. let's see interest rate risk. Already we know fluctuating in the interest rate of the countries which found more sensitive towards asset and liability of the bank, okay. fluctuation of the interest rates in asset and liability will be very difficult to the banks, okay. so here interest rate risk is tolerated by bank by considering as it is not being accepted unexpectedly. so this interest rate will be tolerated by bank unexpectedly. so that is the thing, in an organization offers financial services has to take risk but confirm that the risk taken should be managed without difficulty, and it is also take sufficient care that the risk can be taken should not converted into any other unwanted risk, and also we need to take care about the risk, and that risk should not be converted into such unwanted risk. next we have the various types of interest risk caused in an organization offering financial services, okay, as follows. First type is a rate level risk, okay. so rate level risk is nothing but in the rate level risk the market conditions and regulatory interventions over a given period of time occupies profound effect on your restricted of the interest rate risk, okay. so here our regulatory interventions, okay, our banks, for banks RBI, so they will be having such a regulatory interventions for the period. There may be changes in certain things, okay, and that will be going to affect on your restriction interest rate, okay, where there will be the fluctuating. And next we have volatility risk. In this risk the holders of an option is revealed on the basis of uncertain volatility securities, the mix of assets and liabilities and long run implication of interest rate used for deciding the short term changes effect in cash flow and profits will be causes highly volatile market and this causes the highly volatile risk. Okay, so here they are telling that this will be going to implicate on your interest rate deciding in the short term changes. Okay, and there will be the having closely highly volatility. Volatility is nothing but very much going on, fluctuating ups and downs in the market. Next you have prepayment of risk. Prepayment of risk is nothing but we are paying in advance amount for the risk, okay, which can be generated in a future. The risk is related in improper returns. Okay, when we are not getting properly returns, then this risk will be related of the principle of fixed income. Okay, income security. We know fixed income will be getting, but this time I can't get that fixed income. Okay, so I am ready to bear such risk will be called as a prepayment risk. The prepayment risk it caused due to changes in the interest rate at the payment of interest and installmental of loans. Next we have the reinvestment of intermediate cash flow at lower rate due to the fluctuations in interest rate cause reinvestment risk. Okay, so here we are doing the reinvestments where risk will be causes in a future in a n number of times. So we do keeping on investments in the funds to protect from such risk. Okay, so that is the prepayment of risk, means we are already paid the risk and again once again we are paying for such risk occurs in future. Next, call or put risk. Here the fund which can be raised by issuing securities includes call and put options. Okay, this comes under the options. We'll discuss clearly in the next questions. Okay, here just slightly we'll discuss. Call option is provided the issuer and put option is provided by the investor. Call option is for your issuer, okay, giver or seller, and put option to your buyer. So risk arises when interest rate fluctuate. The call option exercised in decreasing rate scenario, where put option exercised in increasing rate scenarios. We'll discuss further in deep. Next point we have reinvestment risk. Okay, so reinvestment risk, where reinvestment risk is the risk that associated with the intermediate cash flow arises due to payment of interest, loan installment, etc. Due to interest fluctuation, such intermediary cash flow needs to be reinvested, but the lower rate of interest its yield your lower returns. Okay, reinvested risk, it is nothing but from our intermediary cash flow we need to we need to do the payment for the interest, loans, etc. So due to where interest rate get fluctuate in a future, then we do presently and we do payments for such loans. Okay, and again in the future we can buy it and again we can at low interest with highly returns. Okay, so for that we will be going for the reinvestment risk. Next we have basis risk. Basis risk when there is the existence of mismatch between benchmark rates. Okay, and benchmark rates is used in the cost of liability and the yields of assets that link to your single system of floating rates. So benchmark rate is nothing but it will be used in your assets and liability linking to your single system in a floating rate. Next you have real interest rate risk. So here when the variations in the nominal interest rate will be comparable with the variation in inflation, then the real interest rate of cost, liability and yield of asset can be computed. Okay, so that is the real interest rate, and the nominal interest rate minus the inflation rate is the real interest rate. Very, very simple. You can remember this: nominal interest rate minus inflation interest rate, you will be getting real interest rate. The inflation rate over the duration of loan is not determined initially, then the volatility in inflation reflects the interest for both borrowers and lenders. This will affect in incomes and expenses of values of liabilities and asset in the market value. Very, very simple to understand. Remember the formula, that is the thing. So here we finish your second unit. Important questions. Dear students, if you need the deep notes and materials for the preparation of exam, means please install SIA LMR application from the Play Stores, which will be going to help you for writing your exams, and there will be the available previous year question papers. You can refer it for last minute revision. Thank you. Now we'll start important question discussing under third unit. Techniques and tools of risk management, forward contracts and future contracts. First question, explain the concept of derivatives and types of derivatives. Very important questions. Question on derivatives. We'll discuss the term what you mean by derivative and its types also. So derivative is nothing but financial instrument, value derived from your underlying assets and security. Underlying asset is nothing but the price of the current share in the market. We say underlying asset. It is also have a independent value and depends on your assets, commodities, security, shares, interest rate, exchange rate and treasurable bill. So derivatives are, these are all are the terms will becomes under derivatives. Types of derivatives. Okay, in types you have main 4 types of derivatives: options, futures, swaps and forward. And in swap we have interest rate swap and currency swap. We'll discuss one by one clearly. And in options we have put option, call option, American option and European option. So here we discuss the first is options. Okay, option, very important, the term option. To understand, option is a contract between buyer and seller, gives the buyer right but not the obligation. Okay, buyer to buy or sell the asset at the predetermined price on or before a specified date. The buyer pays a premium to the seller. Okay, so for example, if person A and person B is there, so the option will be having 2 types of option, call and put option. Okay, so you want to buy something from the A, you are in a future you are giving the amount to the A, premium amount. You keep this 500 and keep this product with you for up to next month. I will take this product in the same price in the next month. You will promise to the B. Then B will say, if you don't give me, if you don't buy next month, what we will do? You can say you keep that 500 with you only. So that is the premium amount. So like this option is going to work. Okay, so this is a contract between 2 parties. You want to take something from some other party and you are giving him advance some amount, premium amount, to keep that product with him only, not to sell with other. Okay, in the same price you want to buy it. Okay, so that in the future the price increases means you make it profit. If price decreases means you lose only 500 rupees what you paid to the B. Okay, so that is the thing how the options is going to work. Here we have types of options: call option, put option, American option, European option, Asian option. Here in this we have 2 options are very important: call and put option. Let's see what is the call option. Gives the buyer the right to purchase and underlying asset at predetermined price before or specified. Here we are giving the right to our buyer to purchase the any security. Okay, whatever date you want. Okay, whatever date you specified or mentioned. Okay, put option means it is the right given to the seller to sell on specified date. Okay, or any date you are willing to sell the thing. So that is a put option. Next, if you see the American option, it can be exercised at any time on or before the maturity date. It can be sold before the maturity date, no need to wait for the up to the maturity date. Okay, like and European option we need to wait up to the maturity date. Okay, like FDs for, so those things we need to wait up to the maturity date finished, then only we can sell it. These things you can sell before the maturity date also. Whatever the stock or shares you have with you, you can share whenever, but here only after the maturity period what you decided. Next, futures is nothing but making promise to the another party that I will buy these things in a future, not in a present or a past. Okay, and next you have forward, means nothing but today, now only doing the agreement about the future. For that I will take you this thing, buy these shares in future. Okay, so here agreement between buyer and seller for the future date. Okay, now only we are doing the agreement and contract for the future date. For such we say forwards. Swaps is nothing but in which two party exchange payments or cash flow at a future day. We exchange payments now only. Okay, what we doing promises for the future, any exchange of products. Okay, but payments we are doing now only. So that is the contract between two parties mutually understanding. And next we have different types of swaps: interest rate swaps, currency swaps, okay, commodity and equity. Interest rate swap, here interest rate swaps are exchange principal amount. Okay, our exchange principal amount is not exchange. And currency swap is nothing but principal amount and interest payment is different currency and for the predetermined period. Here our interest rate amount is different and our principal amount is different for the different periods. Okay, and commodity swap is nothing but cash flow are exchanged on based on commodity prices such as crude oil, metal, coffee, grains and sugars. Okay, here commodity swap is nothing but different. These all the our products, like they will be going to exchange and the prices will be also getting exchanged. And next we have equity index swap. The payments and cash flow are exchanged based on stocks and market index, which may be fixed or floating. Okay, so our equity are nothing but our exchange based on our stocks and securities, okay, in market index. And next so here we covered about all the call and put options. Next question we go for the explain the role derivatives and security managing the risk, or they may ask explain the various hedging strategies, or they may ask examine the utility of forward and future contracts in reducing the risk. So here the answer is the risk can be reduced by eliminating using a process called hedging. Already we discussed about hedging. Hedging is a financial instrument. Okay, reduces investment derivatives instruments like call option, put option, short selling, forward contract. It is a purpose is to reduce the portfolio volatility and minimize the risk of loss. So hedging, it will help you to minimize the risk of loss in all the options, call, put, forward, futures. Okay, so we'll discuss here strategies of hedging. Forward market hedge. Okay, a forward market hedge is by entering into a forward contract. Already we know what is a forward contract. We are doing priorly agreement between the two parties for the future exchange. Okay, so that is a forward hedging. A company with a long position in a currency, okay, receivable, sells the currency forward, short position in a forward market. Okay, if a company have a long position in a currency, okay, then they will sell it in a forward. Okay, in a short position they take short position. Next, if you see a company with a short position in a currency, they are the payable. Okay, buyers currency forward because they are having the long position forward in a market. Okay, and the objectives is to lock the exchange rate and also eliminate the foreign exchange rates and risk. And next here we have cost of forward hedge. So what are the cost in a forward hedge? So here for cost of forward hedge is equal to forward rate minus your spot rate. Okay, spot rate means the price where you stock price. Okay, that is a spot rate. Forward rate means after the maturity period, the rate of the stock is a forward rate. Future market hedge. Second one, a future market hedge uses for future contract. So how forward is for forward contract, future is for future contract. Futures are standardized contract. Okay, they are buying the specified quantity of and at the future date and fixed price. Okay, and they are traded through the future exchange and guaranteed by the clearing houses. Okay, and the basic principle is to take opposite position in future market to offset the losses in cash market. So that and next, if you see the examples in future market, it is if an investor owns shares and expect market decline or short position, future can be offset losses. Okay, so if you take the short position in a market, there will be the losses. Okay, and from the following in the share, and the share prices also goes follow downs. And next, third, we have option market hedge. Okay, option market is useful for flexible tool hedging risk. So how, and also it is useful for investor users protect against their adverse price movement in a while trading, and also retaining profit opportunities. Okay, option can be used for portfolio diversification, very very important. Next, here we have just simple example illustration. If you see here, Reliance quoted at rupees 300 per share, call option is a 300, strike price is a 30 premium, and put option is a 300, strike price is a price with 20 premium. Okay, call option and put option. So here buy both, an investor can buy both option, call and put option, to limit the risk. Okay, buy shares in the cash market and also protect the position of purchasing a put option. And next, here you have various combination of call and put option can be provided effectively hedging. Okay, so if you use various call option and put option at a time, it will provide you, it will help you for the effective hedging. So takes opposite position in the market is also known as a spreading. So here the two types of spread we have, bull and bear spread. So these options enables investor to hedge risk, speculate and earn profit through the arbitrage opportunities. Next, we have next question, a simple formula, a simple problem. A forward contract rupees 200 share, current trading at rupees 1112 per share, in due in 45 days. If the annual risk free rate of interest is 9%, calculate the value of your contract price. Solution. Okay, so here we need to, what the things they give, we will take it separately. So they give number of share 200, current trading price. Okay, price of the share they give 112, number of days they give 45 divided by 365 you can do. So and next, our value volatility is 1 plus 0.90, that is our 9%, okay, is equal to 0.862. Here we are by substituting the given value in the formula. Okay, formula is nothing but F is equal to NS0 E power VT. Now apply the apply all the things in a formula. You will be going to get 22,639 plus 68. Okay, so here dividend received, given dividend is 22 per share. Next, here 200 into 22 is 4,400. Next, here our value is 400, then again substitute in the formula, you will get 4,379.32. so therefore the value of your forward contract is our, if you keep into the formula, you will be getting 1,821 1800 is your final answer after substituting in a final formula. So that is the simple problem with simple solution. Next, you have explain in details various participants in derivatives market. Okay, so who are the participants and who are the players, we'll discuss in derivative market. Already we discussed derivative market, what are the terms comes under derivative market types, Okay, now who are the players here, who are the participants, we will discuss. Very simple, they are the members. So various participants in derivative markets are as follows. First are the speculators. Okay, they buy and sell such a in a contract. Okay, so their intention is to buy at lower price and sell at a higher price. Their intention is to make a higher returns and higher profits. Such persons we say speculators. Okay, next, hedgers, they derived they are just taking opposite position of the speculators. They don't want to take much more risk. Okay, they want to play just safely in a market. Next we have arbitrageurs. Okay, they want to just make a small amount of profit with very much cautiously. Okay, they are not ready to take large number of risk. They are the arbitrageurs. Okay, buying at lower and selling at higher price. Next we have individual on the floor of an exchange. Okay, so here National Futures Association in the individual. First is a NFA and CFTC. Regulates your futures and options markets. Okay, safeguard the market participations and promote your trustworthy future trading. It will help you for the trading in your future also. Next you have floor traders. Okay, they are the traders, their own accounts, and they called local traders. Okay, and help maintaining market liquidity through your short term trading. Very simple. Floor brokers also can be executed there, others, and they charge such fees for just trading on the spot. Next, some traders engage in dual trading. Okay, dual trading and acting both trader and a broker. So both we say as a floor traders and brokers. Next, other participants we have FCMS, Futures Commission Merchants. Okay, they are accepted and executed by to buy and sell orders in future market. The like types like full service, okay, FCMs, and discounts FCMs. Next you have associate persons. Okay, who are the associate persons? Means FCMs, CTS, IBS, and CPOs. So these are the persons participants in the market. Next, responsible for seeking and accepting the customer orders. Next, CATS are the commodity trading advisor, analyzing the future market and providing advices. Okay, and also manages some your customer trading accounts, we say CATS. Okay, and next we have, that is the small question, who are the participants and players. So those persons are the participants. Next question we have, explain the salient features of forward and future contract, where the different and what are the difference between them. Okay, forward and future contract, explain the difference between forward and future contract. Okay, and otherwise they can ask distinguish between forward and future contract. Okay, otherwise they can ask explain distinction between forward and future contract. So here we'll discuss forward as well as future contract deeply. So first, forward, already we know what you mean by forward and future contract, previously we discussed. Let's discuss now features, salient features of forward and future contract. Okay, features of your options: exercise the price or strike price. It will help you know to decide to know what strike price you need to keep to purchase the share. Next, maturity date, at what maturity date you need to sell your thing. American option, is it available or not, whenever you can buy, whenever you can sell. Okay, that is American option. European option, only you need to wait up to the certain period of the time, at the time only you can deal with the European action. Okay, up to the expiry period. So these are the features, and also you have some different features in both the terms. Premium, okay, the amount will be paid by the buyer, okay, to buy the shares particular date, that is a premium amount. Intrinsic value, gained obtained from exercising the option. Time value, okay, so here it is a additional value will be added into their final spot value. And next, at the money, okay, strike price, it should be equal to your spot price, then we can say at the money. Okay, next, in the money, options exercise result in gaining the holders. Very simple. Next, here we can go for the future features of your future contract. We discussed about forward contract. Now our features of your future contract. Next, recognized exchange. Okay, exchange, traded only in organized exchange. Okay, standardization, contract terms and standardization by the exchanges. So this is the standardization. Clearing houses, third party will be giving the guarantees for the clearing. Margin requirements, trader must mention such margin deposits. Okay, and marking to market, gains and losses are settled daily in the market. Rare exchange of currency. Okay, actually delivery is uncommon in future contract. So it is very much rare you can transfer your currencies, exchange of currencies. Next, you have features of forward contract. So this is a forward contract where there should be the agreement between both your buyer and seller. Okay, buyer holds a long position in forward contract. Okay, for as a short position. Contracts have specific maturity period. There will be the specific maturity period in forward contract, and directly settled between countered parties. Okay, there are the two parties. And next, settlement occurs the contract maturity. It will occurs only at the time of maturity, that is forward contract. Features of swap. Now we are discussing about swap. Very very important. Swap means both the parties are doing a agreement, buying and selling of shares in a future. Okay, that is a swap. Counterparty, agreement between two parties. Termination, maturity period. Transaction cost, lower than many loans agreement. Benefit to parties. Okay, entered both the parties to have some benefit. Documentation is very simple. And next, facilitator, usually arrangement through the banks or financial intermediaries are facilitators here. Next, we have difference between your forward and future contract. Very very important. Many times they asked in your exam what are the difference between. Okay, we'll discuss one by one. So trading, how it can be traded over the counter market. Okay, but it is a exchange traded. Agreement between two parties. There is a settled through clearing houses. Okay, next, contract obligation. Here we have flexible, here we have standard. Okay, so that is the difference. Next, we have credit risk. Okay, either here high, here low. Liquidity, low, high. Price across markets. Here it is a transparent market prices. Okay, standardization, customized contract and highly standardized contract. So that is a standardization. Delivery of goods, it is a specified, but it is a generally not specified. Very simple. Profit and losses, settled at maturity, settled daily. Okay, we know that. And next, marking, no daily marking. Okay, but here daily marking is done. So that is the difference between your forward and future market. Next question, we have a simple problem. Very simple. A 6-month forward contract on 100 shares with a piece of 38 each. The risk-free rate interest continuously compound percentage is 10% per annum, and share is expected to yield a dividend of 1.50 in 4 months from now. Determine the value of the forward contract. Okay, so we'll need to calculate the forward contracts. Very simple. Just remember this formula and go. You can solve the problem. Okay, PV is equal to X. PV is equal to into the bracket F0 minus Fk into e to the power of minus RT. Okay, so that is the formula. Now you need to keep all the terms into the formula. Yes, F is nothing but present value. So here Fk is nothing but current forward price. So let's see how we can calculate it. Calculation for forward contract value. F is equal to present value, okay, of forward price minus old forward price. Okay, so here dividend receivable after 4 months. how much it is? 100 into 1.50 after 4 months. 100 into 1.50 is equal to 150. Your present value of dividend PV is equal to 150 minus, keep into the formula, minus 4 divided by 12. Okay, 4 is nothing but your 4 months, okay, divided by 12, power 0.10 percentage, compound percentage. 150 minus, you get 0.9672 is equal to 145.08. Next you have value of forward contract. Okay, now you keep these things in the formula. Okay, so this is the formula, value of forward contract. Okay, 100 into 38. Okay, this is the 38. Okay, minus 145.08. now e power, e minus rt. Okay, rate and your time value we need to keep here. Next you will get answer 3842 minus 31. Okay, so this is the very simple problem. You can solve with the formula. Please remember formula. Next, here future contract will expire. Next question, expire in 6 months and the continuously compound risk free rate of interest is 10% and the expected dividend rate on underlying stock for the same period is 2% on continuous basis. Find the fair value of the future. We calculated here forward. Now same thing in future. Okay, the formula will be just opposite to the forward. So here let's keep all the things. Current value is 1200. Okay, index value. Next, dividend yield is 2%. Next, continuous risk free interest rate is 10%. Okay, already they gave 10%. Now keep it into the formula. F is equal to S into E power into the bracket R minus Q T. Okay, so S is 1200, R is equal to 0.1, 10%, and Q is equal to 0.02, 2%. So T is equal to 0.5. So it is nothing but 6 month time. Okay, 6 months, 6 divided by 12 you will get 0.5. Now keep the this is the formula, keep all the terms into the formula, calculate it, you will get 1248.97. okay, so this is very simple. This is about forward contract. Okay, so we done here third unit. If you need dear students, if you need overall detailed notes and material, please download the app CI and LMR, where it will use to help you for the last minute of revision at the time of exam, and also there will be the previous year question papers are available. Thank you.